on the breakout, gold's going to make a new all-time highs.
Gold-backed ETFs in inflows of over $5 billion.
$0.8 trillion gold market.
Why are we the only guys that seem to understand this?
Makes your head spin.
Hey everyone, my name is Shane Moran. I'll be the host for this week's episode of Live from the Vault. I just want to remind you before we get started with our call here to hit that like and that share button, subscribe, hit the bell if you want to be notified as these episodes go live. Valuable information as you're about to witness here. So in the comments also, please tell us who you would also like to have most interviewed regarding the physical precious metals market, and we'll do our best to bring them on. And so today's call is going to be exceptional. We are talking about going over to Talking Gold with Andy Maguire, and we've got with us today Craig Hemke, aka Turd Ferguson. He's the founder and proprietor of the Precious Metals blog. That's at TFMetalsReport.com. And he's also affiliated with Sprott Money. So Turd was a licensed security professional for nearly 20 years before leaving the profession in 2008 to become a serial entrepreneur. And since he's become one of the most popular voices advocating for gold and silver ownership by the average investor. So every month, hundreds of thousands of readers go to TF Metals Report eager for his analysis. And very, very excited to have him here. So today it is my pleasure to hand it over to Andrew Maguire of Talking Gold and to continue on this interview with the one and only Craig Hemke. Over to you, Andrew.
Craig, I really want to thank you for this. I know you're away. You've jumped in to an office that isn't even your own. And you know what? I just want to say, you've been such a friend, and not just to me and my family who think the world of you, but also to the entire precious metals community who owes you a great big debt of gratitude. A lot of the work you've done, Craig, is that no one probably sees what goes on behind the scenes there. And perhaps we don't even want to see that, but you are a very, very busy guy. And obviously you've got the support of your family, and I know you are very much of a family man, and it's just my absolute pleasure just to have you here to come to grace us with your presence, because you are a friend and a very close friend. And funny, just a few minutes ago we were talking about how long have we known each other, Craig?
10 years, Andy. I mean, you go back 10 years, I was a young guy. I mean, you were still, but I was a young guy back then.
Well, I think over this last, 10 years, I can't believe it, but that's pretty much when you started the TF Metals site. I think it was 10 years ago, was it?
Yeah, no, it was 2010. And when I first got started, I had heard of this guy, the London trader, London whistleblower, and there was this mythical figure that I just thought was revered, and I thought, gosh, if I only could get to know that guy. And now here, 10 years later, Andy, to be able to consider you a friend, is really a thrill, and you're very kind with the words and very generous in your praise of the site. But again, we are all in debt to you because you are one of the originals in bringing this issue to the forefront, and it is truly my pleasure to be here with you today.
And I think and thank you for that. But one of the things I think that people really get from your service and is you've been helping investors to really understand this very confusing smoke and mirrors market, and the manipulation, the leverage, and even down onto a granular level, so people kind of get it on a daily basis. But I think what is really close to my heart is that, very importantly, what you've done is educate people to really how to this ultimately benefit stackers. So in a sense, to me, what you're doing is You've created the physical spoof.
Well, and Andy, that is the mission. My site, just to make it economically feasible, is a monthly subscription site, but it's only $15 a month. So it's not like we're trying to get rich off this deal. It's about education. It's what you've always been about, because there's no knowledge out there really. The mainstream media doesn't cover the precious metals. They could care less. It's just all about equities and everything else. And so I think a lot of investors, even in the precious metals, think that the price is just simply a dot on a screen, or what they see scroll across the bottom of the screen on their favorite news channel. And that what goes into the price is, physical supply and demand, and all this kind of stuff. Not understanding that there are these nefarious agents in there that are known as bullion banks that make the markets, that are responsible for flowing metal around the planet at the price that is somehow derived through the trading of these unbacked derivative contracts. And it's mainly a function of how those banks are acting at the time, and where maybe they need price for orders that they've got to fill, or for an expiration of options that they wrote a long time ago that are pending. All these different things that you've taught me, frankly, that nobody understands. All the subtleties that go into this. And so that's probably the mission of my side. I know it's been yours, is to make people aware of this, because in the end, the more that you're aware of all of these things that go on behind the scenes of discovering, whatever the price they foist upon you, all of that factors into an understanding of how the thing is manipulated and how false the price actually is. And that's the word we've got to, we've spent 10 years trying to get out.
Well, and I think with a great deal of success, and you have a lot of people that religiously come to you, hundreds of thousands of people come to you on a monthly basis. And I think I was kind of jesting about the physical spoof, because there's nothing illegal about what we're talking about here. We're talking about
Right.
you and many of us all trying to educate people into saying, look, exactly what you just said. Look, this is a paper market, guys. Don't you look at that price. It's not the price. The price is not that price. So look, just go out, buy, stack, go take advantage of a dip. Yeah, we're going to see some market manipulation. We see it on a monthly basis. We see it into every Fed event. We see it, as you so many times have pointed out, when you come to a nice moving average or something and you see some bid pulling going on. I mean, but what you've done there is, instead of people running for the hills, which is really what the COMEX was at the very beginning designed for in 1974, it was like, we have 50 years of create massive volatility, dilute the price. People will run for the hills. But what you've done is say, no, guys, buy that physical stack. Keep buying the physical stack. We will win this war. And that's exactly what you're doing.
Well, and it's always important to know, Andy. A lot of people hear this idea that price rigging, price manipulation is some sort of conspiracy theory. It's not. It's historical fact. And anybody willing to actually take the time to educate themselves, like I did, can figure this out. Coming out of Bretton Woods in World War II, the U.S. dollar was backed by gold and redeemable for gold. Well, by the late 1950s, this became quite a scandal, because the stash of gold that the U.S. had when this all began after Bretton Woods in World War II had been depleted by about a third. As the European countries rebuilt and they began trade in dollars, and then they began to store up dollars in their foreign capital or foreign reserves, capital reserves, they converted it back to gold. Who could blame them? Well, all of a sudden the U.S. lost about a third of their gold, and there was, all this hearings on Capitol Hill. Is quite the scandal. So then over the next 10 years, the U.S. said, well, we're not going to go it alone in defending the price and supplying the gold. So they worked up what's called the London Gold Pool, where in cooperation with 7 other countries, they all pledged physical gold to dump some on the market if price rose, buy some back when price fell back, all to peg the price. That's manipulation right there. They're pegging the price by manipulating it, by supplying metal and withdrawing metal. Well, that worked until it didn't in 1968. So now all of a sudden everybody's going alone. Nixon has to close the gold window and suspend the convertibility of the dollar in 71. Gold begins to skyrocket. And now all of a sudden there's a real shortage. And so what do? Like you said, in 1974, they kicked up the idea of gold futures, which began trading on January 1, 1975. And it was, we know now from WikiLeaks documents, that gold futures were actually designed to make the market volatile. Not only supply synthetic pretend gold to meet the demand for actual gold, a sort of alchemy, but also to make it volatile enough that regular investors said, to hell with that. I don't want anything to do with that. It goes up and down all the time. That's not what I want. And this alchemy now has been extended to the point, as you've written, to where there are as many as maybe 100 owners for each physical ounce in the world. Because these banks and these mints, which we should talk about, some are now getting called to the carpet for their unallocated accounts, have taken 1 ounce and sold it to 50 different people, sometimes 100. And so what's eventually going to happen, and this is why we want so badly for people to acquire physical metal, because every ounce of metal that you buy and remove from the market by storing it yourself or maybe some trusted bullion dealer or something, just get it out of the hands of the banks, because every ounce you take away from the banks reduces their ability to further leverage things and kind of tightens the vice on them. And that's the mission. Again, that this whole pricing scheme, and it is a scheme, is a fractional reserve scheme, just like your local bank runs. And just like a bank run, where everybody shows up at once wanting their deposits back from the bank, we need to inspire a run on these bullion banks, where everybody shows up at the same time wanting their physical metal. And at that point, the system collapses. And at that point, price actually resets to a value that is representative of how much physical metal there really is, not all this phony baloney, derivative and ETF garbage.
Yeah, and I think you just did a great piece. I just saw a great piece you did on Sprott about, I think the subject was when unallocated becomes unavailable. That got my attention right away. That's a really good title.
Thank you.
Because, yeah, because that is a very, I mean, people don't think of unallocated becoming unavailable. I mean, I think what you did in that piece was also, and also you highlighted what I liked in that piece as well. You brought some things in like we're talking about. You mentioned Michael Nowak. Now, anyone who doubts that this market is manipulated, even though despite the DOJ calling JP Morgan a criminal enterprise or organization, etc., etc., and people still coming out and saying, yeah, but that's nothing, that's just spoofing. Hey, just spoofing. I mean, anyway. But what you rightly point out, this goes right to the top of the pile, and actually leads right into evidence that we gave. This is another amazing thing to me. We named this guy in 2010 to the DOJ and the CFTC. It's okay to talk about it now. We couldn't talk about it at the time, but it's clear now. And so this guy sat, as you rightly put, he was the head of global precious metals trading for JP Morgan, sitting on the board of directors of the LBMA. What was he actually doing? He was actually on the fixed price. He was setting the global fixed price of gold and silver. Now, I mean, can you even have a better grip on a lever than to, and this kind of leads into what we were saying at the time, where it's no secret that we gave 88 examples to the CFTC and the DOJ of where the gold price would fix in the next 24 hours. This guy was sitting on the actual fix, and these prices came in later. So what amazes me is that it's such light. Guy should be in jail. I mean, this is such a light treatment for. And now you mentioned something the other day, and it caught my attention. Now, isn't he actually now represented by a legal firm that was actually one of the CFTC commissioners was actually on. So tell us about that.
Andy, this is just, it's not just the precious metals, right? I mean, the corruption in the U.S. and really, I mean, not just the U.S., around the world is now so rampant that, and so bald-faced that it's like, yeah, there's more corruption. And it's like you're just kind of a frog in a pot regarding corruption. There's so much of it now. In a way, it's kind of similar to, people, at least in the U.S., might have seen exposés of how bureaucrats at the FDA, who were once in charge of regulating big pharma, they get tired of making, 80 grand working for the FDA. So they go to some law firm, start pulling down 800 grand and representing big pharma, in legal cases and in trying to get their products through and stuff like that. It's just unholy. Oh, it's just an ugly bastardization of how that whole process should work. Well, that's what I wrote about. I remember I first wrote about this about a year and a half ago in a post I called Abject Corruption, because this just shows you how corrupt this is. Many people are like, well, the CFTC, you'd think they'd do something about this. No, they are simply unindicted co-conspirators working hand in glove with the banks, just like you said, Nowak at JP Morgan working hand in glove with the LBMA. What happened is he got caught, they got caught for all this manipulation. I think the Department of Justice say thousands and thousands of evidences of spoofing and manipulation, so on a daily basis. Well, you knew this, and I knew this, and you wrote all of this up and submitted it through your old friend Bart Chilton to the CFTC, because they were allegedly working on an investigation into silver manipulation between 2008 and 2013. And as you and I both know, they did nothing. The lead investigator in that investigation was a guy by the name of David Meister. Now, that name stuck with me because I used to think of him as Mr. Meister, right? So it's just one of these things that stuck in my brain. Well, when Michael Nowak, who was the head of JP Morgan's Global Precious Metals Trading and a board member at the LBMA, when he got indicted by the Department of Justice for manipulating the precious metals in September of 19, he immediately sought legal representation. Well, guess what? The guy that had been the lead investigator, supposedly investigating manipulation for the CFTC, Mr. Meister, had left the CFTC after the investigation was abruptly closed in 13, found his way to a legal firm in Washington called Skadden and Associates. And when Meister went looking for legal representation, who do you think he picked? David Meister of Skadden Associates. It is so hopelessly corrupt that really the only thing that can change it is a complete upheaval, complete overhaul of the system. And we may be getting there. You mentioned this article I wrote about when unallocated becomes unavailable. And there's a lot of fire, it seems now, where there's smoke. The folks over at Reddit and all these WallStreetSilver folks are adamant, and they understand, and they are full of it. Unlike old guys like you and I that are like, oh, God, we've been doing this for so long, Andy, geez. Man, they're full of piss and vinegar, as we call it here in the States, and they're not letting go. They got the bit in their mouth, and they're rolling. And it's not just the Perth Mint. I saw some stuff today as we record about ABC bullion down in Australia. And there are companies and mints around the world that run this unallocated scam. Andy, I don't want to, go off on this long rant monologue, but may I take a second and just kind of give a real easy example so people understand unallocated?
Oh, please, Craig, go ahead. This is exactly why we're here.
I wrote this up today, a post at my site, TFMetalsReport, and it's a public post, so anybody can go there and find it. And I think the title was just simply unallocated. Okay, so it's real easy to find. You can find it on Twitter now, I'm sure, as well. The example, and I wrote up this example. I've always just kind of verbally given this example in interviews, but all of a sudden it's pertinent. So I thought I'd write this up so that people could really understand. And the best, over the last 12 years that I've been doing this subject of unallocated and leveraged metal has come up countless times, in all the podcasts you and I have done, Andy. The best way that I can explain it so that people understand what I'm talking about is this. If, you own metal in Perth or Montreal or Zurich or whatever, and you do so in an unallocated form because, you don't want to take delivery. there's some risk of having it stored in your vault, and then you feel like you got to insure it. And if you have some other company store it for you, then you got to pay them to store it. And that's a negative carry cost and all these things. And so you think, okay, look, I'll do this unallocated thing because the company tells me I can always get my hands on it whenever I want it. And their fees are greatly reduced. Great, perfect, I'll do it. But what you don't understand is that means you don't actually own it. And if you show up demanding it, they're going to say, okay, sign here and we'll get it to you in 60 or 90 days. Well, what if you don't want to play that game? And think about it to its logical conclusion. Here's the story I always use. Say you live in New York City or London or some other, real densely populated, high cost of living place. And you own a car because you like having a car. There's times you want to get out of town, go out to the Hamptons, if you're a wealthy JP Morgan trader. Or maybe it's just your insurance policy because, in some Mad Max world like we had last year, you need to get the heck out of Dodge. But the problem is, if you ever try to insure a car living in London or New York City, it's expensive as heck. Then you got to park it, right? That's a solid couple of $100 a month, if at least, to park it. So you don't want the whole car. You just would rather have the right to have a car when you want it. So the car garage, recognizing this is a pretty good deal, buys a car, and they sell that car to 50 different people, or at least a privilege of taking it out for a spin to 50, 100 different people in New York City. All of those 100 people think they own a car. They think whenever they need it in an emergency, they can go down to the garage and pick it up, right? But they don't own a car. They all own the same car, and this is fine. As long as only one person in 100 shows up at a time, the garage just says, yeah, here's the car. May not be the original VIN number from the car you dropped off, but here's a car. Yeah, take it out for a spin. As long as only one person shows up at the same time, then that scheme continues and the garage makes a bunch of money because they're storing an imaginary car. Where it all blows up is when word gets out there's really only one car. And when somebody shows up and they're told, well, I know there's an emergency going on. It's Mad Max here in New York City and you got to get out of Dodge, but sign this paper and we'll get you a car within 60 days. What? Wait a second. It says right here, I own a car. No, sorry. It also says in the fine print, we can get you a car in 60, 90 days if you ever need one. Well, then word starts to spread, right? And everybody else that thinks they own the car, they all show up at the garage wanting that car. Well, now, the only person that's getting the car is the first person that showed up and demanded it. And it ain't coming back. The other 99 people are out of luck, right? The garage operators hightail it out of town. Doors are locked. That's what an unallocated account is. And if you want to get your metal that you think you own, you better be first in line to get it. And there are hints right now that it's becoming a real problem.
Well said, Craig, well said. And I think it's important people understand it in that kind of, because we get this smoke and mirrors world and we all have our own terminology. That's a really good way of putting it. And I think the other thing that I would suggest is that there's a couple of issues that happen when there's a sudden run on unallocated gold. And believe me, we're all doing our work here. I mean, I even know of pension fund who's still sitting on a very large unallocated amount of gold. I won't even say the amount, but it's millions. And they still haven't converted that into physical. Now, obviously, there's two things that go on here. If and when they decide, and I believe they are looking at this now, because now that we've had all these cases come up, and they're beginning to realize it's not a conspiracy theory, it's a conspiracy fact. But they're not worried about that. What they're saying is, yes, but hang on a minute. But really, is our portfolio priced correctly? I mean, so we can be cash settled. And so obviously we try and get under the skin a bit and say, well, yeah, you can. And at what price? And how would this, when it is revalued and when everyone comes for their 100 ounces and there's only one, then obviously what's going to happen at that point there is that they'll just say, what they'll do is that they run the game, right? So what they will do is they'll simply say, well, look, here's what the price was before you walked in, before the 99 people following you walked in. So look, here's, you can have the cash. Thank you very much. And so everyone gets paid their cash. But what does that say to the rest of the world? My God, what is the real price? So suddenly the offer to sell anything evaporates. And we don't even know what that price that's about to emerge will be. But I think there's two things that go on in my mind here. So I would suggest to people, look, don't wait your 90, 120 days, 180 days. And believe me, that's what large orders of silver are now commanding on a wholesale basis if you want them from a refinery in large size. And I'm talking about obviously when we try and take a wholesale bar and turn it into kilo bars, we're talking 180 days more. So really what I would suggest is just ask for the cash right now before 99 other people come in and ask for the cash. Then go out immediately on the same hour of the same minute of the same day, and immediately you can click a mouse. You can buy physical gold in multiple ways. You can turn up at from everyone from Sprott, Kinesis, you can go anywhere. You can buy physical gold and silver with that cash and know it's real. Now, that is the reverse spoof. That is it. And so this paper price, but when people do that en masse, expect the price of paper gold to fall a little bit as these crooks suddenly unwind these unallocated contracts, which obviously has a bit of an effect on the price initially, but ultimately watch them scramble to cover themselves.
Right. Well, and Andy, we've seen moments like this before where the price gets bifurcated, and even if they go down that route and start trying to press price lower, if physical demand remains, then the premiums to actually get your hands on it are only going to grow. And so right now we got silver, what, $25 an ounce trading on the COMEX. I can't remember what the dealer was yesterday. It was running a sale, $34 an ounce. So again, what is it? Is it 25 like Bloomberg tells you, or is it 34? Well, it's 34, obviously. If you can't buy it, if you can't get your hands on it at 25, it's not 25, it's 34. And where that works against the banks is you get that bifurcation of price, because people go, wait a second, what's going on here? It says 25, 34, and then 36 and 38, whatever. And that in itself is a threat to the banks and their pricing scheme, because it drives recognition of what a scam it is. We saw it back last March. The paper price in that kind of liquidity event we had with COVID went to 12. But yet you couldn't buy it at 12. It was 24, 25. The demand remained, and finally, eventually, price had to catch back up. They kind of met in the middle before price then exploded from 20 to 30. And that's the kind of thing we want to see now. We want to see enough demand continue. I mean, we're making real progress and putting real stress on the system. But if people throw up their hands because they see the paper price going down, or if they just get distracted by the next blinking light, of Tesla, or whatever, then the physical demand evaporates and the banks dodge a bullet again. But man, if we can keep up that pressure, keep demanding physical delivery, the stress gets to the point where things start moving pretty quick. And that's how it always works, right? I mean, things go parabolic, but it starts out slow. That's what gives it a parabolic look. You start out like this, and then all of a sudden it goes up because everybody catches on at once. And that's what we need. That's what will happen in this event too. And finally, Andy, to what your point is, I know people have asked you this, at least as much as they've asked me over the last 10 or 12 years. What's the fair price then? What is the actual price? And my answer is always, hell, I don't know. How would I know? Because price as it's quoted is dollars per ounce, right? Well, we don't know how many ounces there are. I mean, if you don't know the denominator, how can you know the price? And when we get back to some kind of physical-based system, we have no idea how many ounces with clear title, provenance, and all the rest are out there. And so until we know how many actual ounces are out there backing up this fraudulent system, it's impossible to know what the price is, what it will be once we kind of finally change the system. It's just, you just can't know.
And absolutely right. And that's why I think what's so exciting, this is history, as you say, we're actually at a historic point. We will be looking in the rearview mirror at this year in the future. And historians will look on this. And I think this organic awakening of it's really helpful. I mean, I've seen you support the Wall Street guys, the Silver Squeeze guys. We're all, every single one of us should be supporting this movement because, as you say, what's the price now? If you're an average guy, right, and we get hooked up. Look, we make the mistake of we get hooked up. We watch a 10-minute chart. We're looking at the price, and we work out, yeah, what's the wholesale price? But look at this divergence. No, these guys are saying, I want to stack some silver. They don't look at the wholesale price. It's costing me $35. I'll pay $35. And it's like the price to them is what it costs to get it from a dealer. And so under that is all smoke and mirrors. And enough of these guys, there's something like 9.5 million potential Reddit guys out there, as this organic awakening comes, and we've never had this before, because the Hunt brothers, forget it, they borrowed money from the casino, they got nailed. This is a move into physical that is fully funded. It's nothing to do with the COMEX. These guys are just looking at stacking. And ultimately, if enough people want it at 35, then the dealers will go to the COMEX. They will go to the COMEX and they will buy it at 25 and they will sell it. They will melt it into smaller bars and they'll sell it. And slowly, organically, this is what gives me so much courage at this point. We are seeing such a change. And I know you did a great interview on WallStreetSilver as well.
Yeah, I really love what those guys are doing over there, guys and gals, I should say. And they're dedicated. They smell a scam they know a scam when they see it, and they're on it. And if the worst case scenario is, let's just say it doesn't work this time, and it's going to take another couple years or something before us to reach that point. I don't know, whenever it's going to come. If the worst case scenario here is you're taking some of your dollar reserves, your savings, and converting it into physical precious metal. So rather than have this constantly devalued paper currency, and it's not just dollars, obviously, it's pounds and euros and yen and the rest. If you're taking some of that, taking $2,500, well, I guess we should say $3,400, and buying yourself 100 ounces of silver, if that's the worst thing that happens to you in this deal, we don't break the banks this time, but at least you've got yourself 100 ounces of silver and you've moved some money out of the dollar-based system, more power to you. I mean, that's a win-win all the way across the board. And so it's very important to keep up the pressure. It's very important to understand all of the different ways that these banks have created to try to dilute demand for physical metal. It's not just the futures contracts, but like we said, the unallocated accounts. It's these ETFs. You see the GLD suddenly takes delivery of 12 metric tons, and you're like, wait a second. How could the inventory have gone up 12 metric tons in a day? Were they driving, Brinks trucks around London? No, man. They just took a delivery of a future promissory note to deliver at some point in the future. And if the demand for GLD dries up, then they just take that promissory note and they go, toss it aside. Never had to take the delivery. I mean, it's all part of this massive, fraudulent, and really what it is, a fractional reserve scam. Now, again, I can't emphasize this enough. These fractional reserve things, they work, and they're very profitable for banks. I mean, you can think of your own local bank where you've got your checking and your savings account. If they've got $100 million in deposits, they don't keep the whole $100 million in the vault, right? I mean, they loan out 90 million or maybe 95, or even in the age of COVID, the full 100 million. But they keep some cash on hand for what they call demand deposits, where, Andy, you and I decide we're going to Monaco for the weekend, and we're going to tear it up playing roulette, and I need $10,000 in cash in my pocket just to get in the door. I go down to my bank and I want 10,000 cash. Well, they got 10,000 cash, sure. But if, we're going to take 1,000 of our closest friends with us, and we all show up wanting $10,000 in cash. They don't have that in the vault, okay? They have to go get it. That's a fractional reserve banking system. What we're talking about here is fractional reserve bullion banking, and it's the same thing. As long as one person shows up in Perth, or at ABC Bullion or Perth Mint or wherever, wanting their metal, okay, fine. But if everybody else shows up at once, you got a bank run. Just like, we've seen it, back in the Depression era. And that's what we're trying to do. That's what we're trying to force.
And that kind of brings us on to kind of on the subject of bail-ins, because ultimately, if you can't balance the books, and you have, I think what it's important to say, if people think bail-ins aren't upon us, they are active and they're in force today. And apart from the rules and regulations that allow every single central bank to do that, whether you're in Europe, America, it doesn't matter what country you're in, there is an ability, there is something legislated that they can actually seize your deposits. Now, this is already going on. And I don't think most people, because we've got a lot of exposure to Switzerland, and we have a lot of very wealthy clients in the billionaire range. And unless you've got a good lawyer, you go to a Swiss bank and where you've got 0.75% of negative interest rates, you go to a Swiss bank and you ask for your cash out, because it'd be a hell of a lot cheaper to take all your physical cash, put it in a bloody wheelbarrow and take it in, put it in a much cheaper storage in a insured vault somewhere else. You can't do it. You're limited, unless you've got a good lawyer, to 200,000 Swiss francs. Now, if you're a billionaire, that's like pocket change. Now, furthermore, and we have absolute evidence of this through clients who have gone to Switzerland, and we've said, go and challenge them to get your physical bullion out. Now, in many cases, this bullion has been put in 20, 30 years ago. Over the years, been put into these banks. All of a sudden, I think it's 2003, maybe 2002, but 2003, suddenly all the paperwork changed, where you don't any longer have an allocated bar number on your holdings. So we said, hey, this is weird. Go and ask for your physical bars. These bars that you once upon had serial numbers for. So they go down, and in every instance, at least 3 people we sent down, they were told, sorry, no, you can't. No, you're restricted to 200,000 Swiss franc, maybe 300,000 if you've got a good lawyer. And that includes gold, and people who don't call it a first-year asset, of course it's a first-year asset. They see it as cash. So basically, you can no longer get your gold out because they've got hold of it. And what have they done with this gold? Well, it's suddenly there's no serial number anymore. You can't get your own gold back. We have bail-ins, guys, and these are upon us now. So just want to let everyone know, if you think it's not happening, or it's not, and it could happen tomorrow, please take a look at Cyprus, but also take a look at Switzerland, because if it's happening there, it's going to happen everywhere.
And again, just Andy, back to that same line. You do not want to be last in line. You don't want to be holder number 91. Okay? The music's going to stop, and you're going to need a place to sit. And you got to sit pretty fast. Yeah, again, I don't know. Maybe it'll be fine. Maybe we'll just sail along here, and the price of gold will rise regardless, and silver too, because of the stagflation and the negative real interest rates and the yield curve control that central banks, including the Fed, are going to have to apply eventually as a way of inflating away all this new debt. I mean, that's a recipe to make the price go up anyway, and maybe that allows people to become complacent, and I don't have to worry about it. Look, gold's going up. I'm not going to worry about it for now, and everything will be fine, at least for now. But man, why would you want to take that chance? When you've got Kinesis, and you've got great bullion companies, and you've got all these other options, why deal with these banks running this scam? I just don't understand it. And again, it gets back, I guess, a little bit to what we talked about earlier, is that people just don't understand as well as they should or could how this market operates and how price is discovered and who the actors are behind the discovery of price and why they do what they do and how long it's been in place and who sponsored it originally and the history of all this. I mean, you got to take some time to learn this stuff. And then once you do, oh, geez, your eyes are open and you become a grizzled old veteran like you and I because you get the bit in your mouth and you can't let it go.
But you know what? If we start looking inside, or listen to that gearbox, the COMEX gearbox, there's something rattling around in there. And I think what's interesting is all the things we've talked about. People are becoming aware, and so I saw you tweeted something the other day, and I thought, oh, I hadn't noticed that. You now have what, and I'll fast forward to now because I'll lead to what you were pointing attention to. There's only 5 trading sessions now for the March contract to expire, and I looked this morning, and there was over 9,400. There was more than 29 tons of gold standing for delivery in the March contract. But Craig, what then I thought, oh, let's have a look at silver. Holy smokes. I mean, we are talking, and bearing in mind that silver is basically, the largest delivery month was December. We're already nearly 300 tons larger standing for delivery than in the biggest delivery month of the year, when the average for January, February, the average was 300 tons. We're now talking thousands of tons coming out. This is huge. This is to do with people being educated, to do with the Wall Street guys, to do with all the things we're talking about. So tell us a bit more, and what drew your attention to that?
Andy, this kind of gets back to what we discussed earlier, about the banks trying to maintain this system, and how the bifurcation of price is a threat to it, right? Well, they have to defend the COMEX price. They have to make that seem as legitimate as possible. And you and I have been following for years the abuse of what's called the exchange for physical process, which is this arcane thing built into futures contracts that allows you to swap out your contract kind of off exchange into physical metal. And the COMEX will allow you to do it even into shares of the GLD. And what the banks were doing in increasing numbers the last couple of years was abusing this process, at least as I understand it, to arbitrage the difference between the futures price and the spot price. Well, when everything blew up last March, and you think of, this liquidity crisis, the market's melting down, Fed having to introduce all these, these temporary facilities and QE to infinity and all this other jazz, the COMEX damn near blew up as well. At least the relationship between the futures price and the spot price. And we had, and I know you know this, Andy, contango between the spot price and the futures price that reached almost to $100, where the futures price was, whatever it was, $1,800 an ounce, but the spot price was $1,700. Now you would think, well, why wouldn't you arbitrage that, right? You buy it spot, you sell a futures contract to deliver it a month from now or a couple of weeks from now, and that gap closes naturally, but it didn't. It stayed wide and stayed wide for months. Not at that level, but at, $20, $30, $15, whatever. And what that told you was the COMEX had broken, and there was a crisis of confidence because people weren't believing that if they bought now with a promise to deliver a couple of weeks from now, that they would get the metal in time to deliver. And then they themselves would be in default. And so you had that's why that ARB didn't close. That gap between futures and spot didn't close. So the COMEX and the LBMA took all these unusual steps last March, and anybody can Google this stuff and read about it. I wrote about it a lot and talked to you about it a lot back then. And they developed these brand new contracts, and amended the current contract so that you could actually deliver fractional ownership of a London bar. So rather than a 100-ounce COMEX bar, you'd get delivery saying, well, here's a 25% ownership of a 400-ounce bar that's in London. What? No, that's, huh? But they had to take all these steps, including flying all this metal into the COMEX vaults. And the COMEX vaults used to have 8 million ounces in them, and now they've got like 25 million. All of these steps to shore up the COMEX with physical metal so that you could access physical metal there to legitimize the price that's discovered there. Okay, because if you can't deliver metal at that price, then what the hell are you discovering? You might as well be trading baseball cards. So all these changes have taken place in the last year. And because of that, getting back to your original question, Andy, the delivery demands on COMEX have soared. Where we used to do maybe 10,000 contracts, maybe in a delivery month of COMEX gold, right? That's 1 million ounces. Suddenly in June of last year, we did 50,000 contracts for 5 million ounces. And that continued into every delivery month, which is every other calendar month, where we did 31,000 something in December and 36,000 this most recent in February. Well, now here's the interesting thing, as you mentioned. March, this current month we're in, it's not a delivery month. The current front month for trading purposes of volume and for delivery is April, okay? And that April contract actually goes off the board a week, or actually it's coming Tuesday, the 30th. 5 days. All the while, though, the March contract, which nobody uses, nobody ever traded, there's no volume in it, there never has really been any volume in it, hardly any open interest, has been going off the board and in its own delivery. In the past, let me lay these numbers on you, Andy, because I had to memorize them for a post I wrote a couple weeks ago. The last March, when all this crazy stuff was happening, COMEX actually delivered something like 2,900 March contracts, which was extraordinary because in the previous 5 Marches, 2015 to 2019, the total amount of deliveries for the 5 previous Marches combined had been like 837. Okay? So the average March was a couple of hundred contracts. And then it spiked to 2,000 last year in the craziness. And as you said, we're going to come in almost 10,000 this month, this March. So if you take 2019 out of the picture and use those previous 5 years as kind of just quiet, normal, everybody's happy with COMEX trading. March deliveries this month are about 25 times the average. And so now we're going to roll into silver. The March silver was a front month. It's about 11,000 contracts delivered for 55 million ounces because it's 5,000 ounces per contract. We'll just see. We'll see if this trickles through. If COMEX is used as a delivery vehicle, continued to be, it's putting great stress on those banks there. And that's all part of what we're trying to accomplish.
And I think one of the beauty of this is that, as we say, this, and it's good to step back in history and see this in 1974. This contract was, and then also the silver contract followed. But essentially, what they've done is shoot themselves in the foot, because with this sudden attack on physical, which is everything we've just talked about, it's an upsurge, it's a natural, it's an organic sudden growth for people wanting physical, because there's too much evidence out there, too many people waking up to this. Now, what happened to cause this issue was them shooting themselves in the foot, because look, there's such a paper market. Physical in that casino, the doors are shut. There's nothing happens outside in the real world. You're in this casino, and unfortunately, a lot of Americans were banned from trading the over-the-counter markets, where, by the way, there are no halts in market halts at all. You have the same market makers trading in the over-the-counter markets, but the average American citizen or even investor cannot trade anything but the COMEX. So now you're inside this casino. The oxygen's being pumped in. The doors are shut. There's no mirrors. It's that you're in there, right? So what happens is people who have lost sight of the physical market, then suddenly you've got, I'll tell you what, let's connect an algo to the dollar. Let's connect an algo to bond yields. Hang on a minute. We need to sell. So sell. Now, what did we see on the other side? Backwardation. We actually saw at one point a $5.90 backwardation, i.e., the spot price was trading $5.90 higher than the futures price. Now, what does that do? Immediately, there are smart people out there. They're saying, crazy, I'll take that, thank you. And we saw our Swiss trading banks jump on it. We know that there's several other banks that jumped on this trade. Why wouldn't you? Because you've got money, you've got resources to do it. So you stand there and say, well, thank you. I'll take delivery of that because it costs me roughly $2. If I'm in Switzerland, it needs about a $2 backwardation for me to be able to justify taking it off the COMEX at 50 cents an ounce, adding transportation costs, the friction of that is about $2, $1.80 to $2. $5.90, thank you very much, give it to me. And guess what? And as you just said, yes, the illusion of this physical is there. So what will happen is there'll be a lot of warrant shuffling as per usual, but these guys are actually in there to take delivery. And we talked a little while ago, in November was the last time we saw this form of arbitrage opportunity. I just happen to call it the catch-22 arbitrage trade. Now, in silver, it caused an $8 spike directly after the delivery demands in silver. In gold, we saw another spike higher. And what it is that they don't have the physical to deliver. And we know that in November, 2 of our Swiss banks friends were given $40 an ounce to not take delivery. You can't do that. It must have cost, we reckon that was close to 10 tons between them holding those physical. That is $12 million at the time that it cost the casino. Casino's not there to lose money. And yet they're caught in a catch-22 because you don't want to deliver the physical. No way. And silver? Who the hell is going to deliver silver at $25, $26? They know it's worth $10, $20, $30 more. So this is an interesting dynamic. We're seeing, that's why I said, you could look at the gearbox. You can hear it rattling. Something is broken in there. And really, guys, I think what we're saying is, both Craig and I are saying, buy physical and you cannot lose.
That's exactly right. That's exactly right. And again, these banks are attempting to walk a very fine line of managing the price versus their short positions, but trying to deliver an evaporating physical metal at that price without causing the price to go higher and squeezing the vice even tighter on their short positions. And it's a very steep challenge that they have, and I know they're got to be appreciative of that. And that's why, and again, you see that more maybe desperation then in the price movements. Even just yesterday, Andy, I mean, out of the blue, 9:05 Eastern, silver falls 60 cents in 10 minutes. You know, and it's, how does that work? But the dynamic is definitely against them. They're working off of flow, not stock, and flow is tight. Just some numbers so people understand. Even in the age of COVID, I think the world probably managed to mine about 800 million ounces last year, maybe 850 of silver. With the positions having been pared back some, the banks, the swap dealers, the commercials, whatever you want to call them on COMEX, the biggest 8 traders are still net short over 50,000 contracts. That's 250,000 ounces. They are net short. Well, 250,000 ounces is about the retail investment demand on an annual basis for silver, because you crank out 850 to 900 million ounces every year out of the mines. Industrial demand year over year eats up about 525, 550, maybe 575 million ounces. Just eats it up, consumes it, right? And all the electronics and stuff. What's left over is the investment demand, the silver for investment demand. So let's call that 250 million ounces. You know, what did I say the banks are short? About that. So when investment demand eats up all the available silver, and we're on track to blow through 250 million ounces this year, well, then there's none left. And you get things like what we're seeing, not only these bank runs, but what the U.S. Mint isn't going to crank out new Eagles for the next 60 days, right? Didn't the Royal Mint just put out something? They're not going to be cranking out any new silver rounds. I mean, because there just isn't any. I did an interview with a guy named Josh Fair 3 weeks ago. Anybody can go to my site and find it. It's a public link. Josh is the CEO of Scottsdale Mint, which is one of the biggest private bullion producers. They make rounds for 45 countries, okay? And he said at the time, his quote, that there was no silver grain in existence in the U.S. at that time. None. He could put it in an order, maybe get some in, 90 days, 30 days, but none in existence. And again, that's how all these pieces fit together. So if we can keep the demand up, keep just buying up all of the physical silver that's not only currently in the stock, but also being mined, really puts these banks in a jam. And that's what we want to do. We want to force them into a short squeeze. We want to force them to cover their shorts at higher and higher prices, eventually get out of the business because they find it unprofitable. And then eventually we're making some progress to finding an actual fair price.
Yeah, this is it. We said before, what's the fair price? I think it's interesting. Both of us know John Hathaway. He works with Sprott. And I knew him very well at Tocqueville. Very, very solid guy. This is a guy with pragmatic and very well seasoned. And he reckons there's 100 trillion of institutional money under management. So what he's saying is, and it amazed me because I hadn't thought of this recently, if just 1% was to move into gold, that'd be $1 trillion moving into gold. And if you put that into context, that's 6 years of mine supply. And so he's saying, well, gold has to be worth 5 times its current price, which is 8,000-9,000. But I mean, I think, that's interesting because, sometimes we get caught up in a 10-minute chart and we, lose sight of the big picture. But what I thought was really interesting is that, how foreign central banks value gold as we move into Basel III and Basel IV deadlines and starts in June 28th. And now, what it does, what they're seeking to do is address a major imbalance, basically, which is that gold's collateralization of US foreign obligations, which is an important factor that people forget. It's reached absolute historic lows. Now, really, I think this is one of the main objectives because people say, well, Basel III, Basel IV here, but, really does a central bank really want a higher price? Yeah, I think one of the main objectives is, in other words, to protect dollar hegemony. We see this as the primary reason they must allow gold to be revalued higher. And so it's a simple formula. The current ratio of gold to foreign debts is currently 5 or 6%. This should be, and historically has been 20 to 40%. So otherwise, you're questioning the dollar. And so really, I think the BIS likely expects this ratio to come back to 20 to 40%. So if you just use the simple sums of a price today, and you then extrapolate this back to 20 to 40%, you're looking at least $6,000 to $12,000 per ounce. And I mean, these are not pie in the sky numbers. And silver, I mean, if you just use the same ratio, now, Craig, what are we seeing? 60 something to 1. It was 128 to 1 for the, I mean, even if you use 60 to 1, I mean, that puts silver at 95 to 190 bucks an ounce. So, I mean, really, this is crazy, crazy levels. What an opportunity, guys, out there.
And to protect yourself from that, so that you have that metal in your hands when that happens, because it is going to happen. The system always resets that way. I mean, history is replete with examples, going back millennia of currency failures, that began as being sound and backed by something and eventually failed as completely unbacked and worthless, whether it's current day Zimbabwe or Venezuela or Weimar Germany or back to the Roman Empire. I mean, that's just how it works. And then everybody loses faith and confidence in that currency. And so the only way that faith and confidence is regained is by starting over and backing it with something again. And I mean, this is not, I mean, we're not splitting atoms here, Andy. I mean, this is just how it has always worked. And that's how it'll work again. Now, you bring up an interesting point with these central banks because the central bankers, especially in the U.S., are dreadfully afraid of deflation. I mean, they have to have inflation because you have to constantly be growing your economy and your money supply so that you can service all of these existing debts. And now the debts have gotten to be so extraordinarily high that the only way you can even begin to service that debt is by keeping rates low and printing more and more currency and trying to inflate it away. So they can't have deflation. They got to have inflation. So all of a sudden, maybe after being the mortal enemies of gold and, the great work of GATA, with Chris and Bill, they've laid all this out over decades. But maybe instead of being mortal enemies of gold, they're at least agnostic, if not in favor of higher prices, because if they were to revalue gold higher voluntarily, then, they'd probably get some of that. They'd fight off that deflation they're so worried about. And the thing I think they should really be worried about, and you and I have discussed this for years, is whether they're forced to do it involuntarily. Because maybe a country like China, which clearly has at least 10 times the amount of gold than what they officially state, maybe suddenly they are the ones that see some value in offering a sound currency with confidence behind it as a strategic play against the West. And they come out and say, you know what, going forward, we're going to at least partially back the yuan with, some bit of our actual 40,000 tons of reserves that we have. All of a sudden, everybody would want yuan. They'd want nothing to do with dollars and yens and euros. And so that hand might get forced on the West, whether they want it or not. All of this, again, Andy, we could talk about this stuff all day, but what it does, I mean, if people need to understand, if the central banks of the world and in the last couple of years have seen record central bank demand for gold, if they are taking their foreign currency reserves, dollars and euros and yen, and liquidating them and buying gold, don't you think it'd be a good idea for you to do it too? I mean, at least some. And that's what we're talking about here. As I know, we call it the end of the great Keynesian experiment at my TFMetalsReport site, and that's where this is all headed.
Yeah, I mean, and this is it. I mean, you just nailed it. That's absolutely it. And so I think, I mean, you know what? I really value your time here. Craig, we're gonna have to do this some more because we only got through a fraction of kind of where we wanted to go with this. But I mean, look, I just wanted to ask you because I think I've heard no one talking about this really. We just saw. Just following, and I don't think the timing is in the least coincidental. So Scotia exited market making on the COMEX, right? Now, funnily enough, at exactly the same time, suddenly there's an upping of position limits in silver from 1,500 lots to 3,000 lots. And my suspicion is this is to shuffle more chips back to the casino insiders because Scotia's now gone. So whoever's left needs more to play with. What's your thoughts on that?
Yeah, that's probably right. That's probably right. And I've hassled the CFTC on this before because these banks are consistently blowing away the position limits every month. It's 3,000 contracts which trying to keep them all straight. 3,000 contracts in gold? No, it's 6,000 in gold now, right? They up gold to 6,000 and silver to 3,000.
6,000 in gold, 3,000 in silver.
Yeah. So anyway, you'll get
from 1,500 to 3,000.
Yeah. So you see the delivery reports.
Yeah.
And the house account, the proprietary account at Goldman Sachs or at Citigroup or JP Morgan will deliver out in the delivery month something way beyond what the stated position limit is. And so I've hassled and badgered the CFTC for years, and all they ever say is, well, they have a bona fide hedging exemption. And so they can do whatever they want. They can, well, if you can sell as many contracts as you want against an alleged not even proven hoard of metal that you claim to have, that gives you monopolistic control over price. And in doing so, you can put on the shorts when price is going up, and then you can raid the price and cover the shorts when price goes back down. And if you got a monopoly, as with any industry, you can make a lot of money. But what Scotiabank has found is you can't make as much money as you used to be able to make. Spreads are tighter, and people are figuring out what a scam this all is. Then you've got the legal troubles like Scotiabank had and Deutsche Bank had and JP Morgan has had. So you got the compliance department breathing down your neck going, what the hell are you doing over here at this desk? And pretty soon it's just not worth it anymore. And so that power, that concentration gets into fewer and fewer hands, but that's okay. The fewer hands you have, the easier it is to squeeze them because the pain is more focused. It's not as diverse. So we're just going to keep up the pressure, my friend.
Yeah, our dear friend Bart Chilton raised this in 2000. In fact, the whole reason the CFTC, the March 2010 CFTC meeting was called was because of the concerns of one bank. We all know he said it in a later stage what the bank was, JP Morgan, holding far too much position of a concentration of position. I mean, at the time it was 40%. Actually, if you go and connect, and if you go back to 2010, 2011, and you go to the Office of the Comptroller report.
Yeah.
So if you compare the reports from the Office of the Comptroller report to the bank participation report, to the CO2 report, you connect the three dots, and you'll see that JP Morgan held 98.9% of all derivative gold and silver positions. I mean, this is massive, and we even provided this information to the courts as expert witnesses when they was, and of course there was no discovery at the time, and so really it didn't. It really took years and years and years later for that to play out. But hey, you know what? I think. Thank you. I was going to say, Craig, thank you so much for everything you are, what you're doing for everybody, and I really just want to say to people, look, please go and visit Craig's site. He's on Sprott too, but Craig, you've got two different services. I think is it two different services you offer at TF Metals? Can you just tell everyone how they can follow this great service of yours?
Thank you, Andy, and I appreciate all the kind words. And I'm sitting here thinking, maybe we should do something fun. Occasionally, I'll offer a discount code for anybody who wants to join it, just to take some of the sting off of joining. If you want to kick the tires, you mind if I crank one out just for everybody that's been watching? Would that be okay?
Go for it.
Let's call let's make the code Andy. How's that? All right. So, for as I mentioned earlier, my site, it's subscription based. That keeps the trolls out and keeps the lights on, but it's only $15 per month. You can buy an annual subscription. It's $145. But for a month, it's $15 a month. If you want to sign up, if you want to continue this discussion, if you think there's some value to what I do and the guests like Andy I bring on, you can come to TF Metals Report, buy yourself a monthly subscription. Again, it's $15 a month. If you type in the coupon code at checkout, coupon code Andy, A-N-D-Y, you'll get half off the first month. So it'll save you a whopping $7.50, right? Which is maybe a pint of brew down at Andy's local pub. You can have, it'll pay for your first pint or your lunch one day. But anyway, it'll save you $7.50. If you stick around after that, it'll be $15 a month going forward, but at least give you a chance to come check it all out for 25 cents a day rather than 50. The site, I provide analysis every morning, podcast every afternoon. I'm on the site all day in between, adding comments and thoughts on headlines and charts and all that kind of jazz. The community is global. There's people not only in the U.S. and Canada, but Australia and England and Switzerland and everywhere that you can think. All political stripes, but we all realize we're all in the same boat, right? We're all against the banks. We're all fighting this debt madness. We're all just trying to help each other out. So anyway, Andy, I appreciate all the kind words. It's TFMetalsReport.com. monthly subscription, coupon code Andy, save you $7.50 the first month, and we'll welcome anybody that wants to come join us.
Hey, and less than a price of a Starbucks coffee from Monday to Friday. I say, what is the value, guys?
Thank you. I appreciate it. And that's by design. We don't want to price people. I mean, we're trying to help, right? I mean, and we're trying to help people. So we don't want to price people out. So we want to keep it as affordable as we can. And thank you, Andy.
No, that's brilliant. And I want to thank you for coming on the side. Look, Craig, you've got to do this again. I mean, God, there's so much wealth of knowledge, and when speaking to you, it unlocks all little light bulbs keep going off, and we go places perhaps that sometimes we wouldn't normally go. So, but thank you so much for coming on, and I really hope you'll come back and visit us again.
Thank you, Andy. Anytime you ask, I'll be more than happy to join you.
Well, there you have it. On behalf of the entire Kinesis worldwide community, thank you, Andrew Maguire, and especially our special guest, Craig Hemke, for this week's historical edition of Live from the Vault. And to learn more about Craig Hemke, as you heard, just visit the TF Metals Report at tfmetalsreport.com. That's tfmetalsreport.com. And we'll insert a link below here in the description, and make sure you remember the code is Andy. All right. Now, as you can imagine, the Kinesis community is growing super, super fast, and be sure to help us spread the word about this channel by liking, sharing, and subscribing. If you want to be notified when these episodes go live, just hit the click on that bell notification there. And to learn more about Kinesis and the Kinesis monetary system, visit kinesis.money and sign up for your free 12-part video learning series. And with that, we look forward to seeing you next time on Live from the Vault. Bye for now.